Hi, Stefan Wård here from Pareto Securities. I'm here today with Chris Watling, CEO and founder of Longview Economics, to discuss the current outlook in financial markets and the economy in general. Longview is an independent research provider of the financial markets. It was founded in 2003 and has since established an outstanding track record of research and advice for traders and investors across the globe. Pareto Securities and Longview has a strategic partnership in which Longview provides macro and market research for Pareto. With that, please go ahead, Chris, and take us through your material.
Well, thank you, Stefan, and thank you, Pareto, for hosting this today and putting it all together. It's a pleasure to be with you. I wanted to talk about, as you can see from the title, after that, what's next? Really sort of how the next 6 months might play out. It's been a pretty punchy relief rally, as we all know, and we can see on the sort of first slide on the page in front of you, coming up in front of you now, that the relief rally's been strong and hard. The Nasdaq and the S&P and a whole bunch of other indices have really rallied pretty hard. In fact, if you look at the numbers, the S&P 500 is up over 36% from its intraday lows on March 23rd to its intraday highs that it reached last week. And the Nasdaq's gone up 38%, the DAX is up about 40%, and so on. And as you can see on this chart in front of you now, it's now meaningfully overextended to the upside. The markets had, as I said, an aggressive relief rally. There's a whole bunch of our models that we use for market timing on a 1 to 2 week basis, which are now pretty stretched. This is one of them. This is simply a technical model that shows the market relative to its trend line and how aggressively it's moved relative to that trend line. But equally, if you looked at risk appetite, you'd see the market have become greedy. Positioning has shifted an awful lot from very bearish to mildly bullish, I'd say, in the last few days, couple of weeks. So really, the market's pretty meaningfully overextended to the upside. And then if I look at other asset prices across the globe, I look at the next slide, you'll see that there's a whole bunch of other asset prices that aren't doing nearly as well as the S&P or the Nasdaq. It's been a very concentrated, narrow rally, as we've seen. The big FANG stocks have led it. Tech in general has been very strong. The S&P 500 has retraced about almost 2/3 of its losses. The Nasdaq has retraced about 3/4. But other asset prices, as we're showing here, are much less impressive. So you can look, for example, at the emerging market currency index, which is really flat at its lows, pretty much trading at its lows for the last month. No sign of a bounce there of any significance. You could look at global banks, which have been really unimpressive in their price action in the last few weeks. Or you could look at a whole host of things. We're showing you the US high yield spreads here, and the fact that they haven't, in the last few weeks, since mid-April, they haven't really followed the lead of the VIX and the lead of equity markets. So a whole bunch of other asset prices are not really doing what you see from the S&P and the Nasdaq. Tech's been a very narrow leadership sector of the global markets as a whole, and the relief rally outside tech and outside the S&P is not nearly so impressive. So there's a whole host of risks. Interesting to look at the valuation on the S&P 500. So if you pull up the next chart now, you'll see that the S&P 500 on a forward PE ratio, so we're looking at rolling 12-month forward PE ratios here, excuse me, is running at one of its highest PE ratios really since the TMT bubble in 99-2000. So on the latest forward earnings, 12-month rolling forward earnings, consensus earnings, these are not our estimates, this is what the consensus says, that the S&P is trading on just short of 20 times those forward earnings. So it's a very expensive market, which I think is quite something given the risks that are out there that I'll come on to in a minute, and also given the challenges that we see in the global economy and global equity markets. But equally, what's also interesting is if you look at the global consensus earnings, I would say they look pretty complacent to us. So if we pull up the slide of the global consensus earnings now, you'll see really either in the US or the global economy, indeed in Europe, if you look at these things, they really trough and fall about 20, 22, 23% this year in 2020, and then they bounce by a similar amount next year. So they get back pretty much all of their losses in 2021 on a consensus picture. And the question we have to ask ourselves is, how realistic is that? Is that really a realistic, likely outcome? Look at unemployment in the States. It's 6 weeks of jobless claims. We've now got 30 million initial jobless claims over those last 6 weeks. We're going to get non-farm payrolls later this week, and it's likely that the jobless numbers will go down by 21 million. So how realistic is it to get this V-shaped recovery in earnings and V-shaped recovery in GDP, excuse me. So actually, if I think about it, and this is what I want to talk about today, it's what I call the reckoning. You know, after that, what's next? So we've had this punchy relief rally. Is it realistic to expect it to continue? Or actually, have we got some real challenges with the global economy looking forwards? And I think what people don't really have a full grasp on here is that what we've seen in the last 2 or 3 months is a forced recession, forced lockdown. It's a natural disaster type economic shock. It is a recession, it's deep, but really it's an economic shock, and it's a one-off. The market, the economy goes down in Q2 and it bounces in Q3. And in fact, this is the work here on the demand side of the economy in this slide we're showing you now. If you look at household cash flow in the US, or indeed many parts of the world, people are saving money, of course, under lockdown. And you get all sorts of things going on here, but really 3 main factors playing out. Unemployment's up sharply, so income is down on the back of that. That's some of the top lines we're looking at. Then the second area you see here is spending. And of course, people are forced to save money because they're under lockdown. So they're building cash in their bank account if they still have a job. And then the third aspect that we look at here is, what is the fiscal stimulus doing in terms of putting cash in people's bank accounts? And we know in America that's very aggressive. In fact, on the next slide, I summarize those 3 key areas, and you get a sense of the real numbers. And in fact, if you look at it, household income's going to drop about 800 billion. Household spending's going to fall about 1.3 trillion. And then the fiscal stimulus is just short of $500 billion. So you add it all up, there's an extra $1 trillion of cash in people's bank accounts. And my colleague Harry Colvin's been doing a lot of work on this and talking with Pareto about this very aspect. The point is, though, what does this do? This gives you your Q3 bounce when people have that cash to spend. So consumer spending bounces, as you can see in the chart. And that's all well and good. You're getting a sugar rush of fiscal stimulus. And I think what is really interesting is what happens beyond that. Because to my mind, the punchy relief rally is pricing in the punchy fiscal stimulus and the sugar rush bounce in Q3. And what I think is most interesting is what happened in Q4 and in 2021. And in fact, if we look on the next slide, we start thinking about the supply side of the economy. So that's the demand side. In fact, sorry, this is the way some patterns of spending may well change actually as we go forward. But let's skip onto the next slide beyond that, which is the supply side of the economy, whereby, of course, if you look at it from a top-level picture, the fiscal stimulus from the US is very big, and it's one of the biggest in the world. In fact, the Bruegel, which is a European think tank, have split it into 3 categories here. And the immediate fiscal impulse, the first column you see, is really cash spending from the government, whether it's through households or through businesses. And you can see the US number is 9.1% of GDP. It's the biggest in that column. It's very punchy. A lot of that 9.1% in household spending, but a part of it is also support for the business side. So about 1/3 of that goes towards businesses, and that is interesting to think about. But the challenge on the supply side is how much of that 3.1% is getting through. So of that third of that 9, quite a lot of it is struggling to get through to small businesses. So we've been doing an analysis of the loans, the payment protection program loans in the States, looking at how much of them are getting through to small businesses. The Small Business Administration in the States is administering this program. And tranche 1, they gave out $342 billion US. And of that $342 billion, 1.6 million small businesses received a check under that. of the 30 million small businesses that are out there. So about 5% in tranche one of small businesses received a check from the CA. That helps them cover payrolls and things like that. But of course, it's a very small number. It's a very small number of the 30 million small businesses who are out there. And of course, we've now had a tranche two of this because Congress is worried about the money not getting through. And in tranche two, we are seeing that about another 2 million or so small businesses so far have also got a check. So to date, we're at about 15%, or we're likely to get to about 15% of small businesses receiving one of those checks from the Small Business Administration, covering their paychecks, covering their staff costs, covering a bit of their rent. But of course, 85% of small businesses are not likely to receive any fiscal support from this program. And then, of course, if you consider that of the 30 million businesses in the US, they account for over half of private sector employment, and they account for 2 out of every 3 of the new jobs that are created in the US. So 85% of those businesses are not being supported. Maybe 15 or 20% don't need any support, but certainly the vast majority do. So there's a very big challenge on the supply side of the US economy. And I think that's why you see in the initial jobless claims, the next slide that we're showing you now, there's such a big number in the US. Initial jobless claims over the last 6 weeks have jumped by an aggregate 30 million jobs. To give you some perspective on that, there was about 160 million jobs in the US, people employed before this crisis. So 30 million is a very big, chunky number, accounting for a very significant percentage. So unemployment's up a lot. The furlough scheme in the US is not working as well as it should. There are problems with the supply side of this economy. That makes me nervous about Q4 and 2021 after the sugar rush of the household cash flow has worn off. And when we get into what I call the reckoning and the reality and the challenges that the US economy has out there. So if I think about this market now, I think about how expensive it is, and then I think about all the list of uncertainties that you can see on the next slide that sit in front of us after the Q2 downfall and the Q3 bounce. There are several uncertainties. How will social distancing change restaurant revenue profiles? How will companies like Disney and other entertainment companies cope with social distancing and the like? Will the virus come back later this year? How effective is that supply side support going to be? And why do we have a record high PE ratio on the S&P when we have record high unemployment? That is very unusual, and there are no examples of that in history. So, you know, there's a real argument here that the cheap money bubble has burst in the US and globally. The zombies are being exposed. The unicorns are going to come under pressure. All the listed IPOs that aren't making any money are going to struggle here. And credit conditions, I think, are starting to tighten. So we've had the first phase of this pandemic, the economic shock. And I think now we have to start worrying about the plain vanilla recession from Q4 and in 2021. And that's what worries us about these markets. And that's why in our final slide, we've gone underweight risk in our global asset allocation portfolio. In the last weeks, we enjoyed a bit of the bounce from the lows on March 23rd. And then last week, we started moving underweight aggressively in strategic portfolios on a 6-month plus time frame. So it's been a punchy relief rally. Now it's time for the reckoning. There's plenty to worry about. Be cautious, I think, in portfolios is our recommendation. Thank you, Stefan.
Thank you very much, Chris. A few follow-up questions, if you may. We're sort of expecting another retest then of the low seen in March. And I would like to get your view on when or in what type of environment and positioning you would become slightly more optimistic on equities in general, I guess with emphasis on the US.
Yeah, I mean, I think a retest is very plausible, or potentially some new lows. If you think about a fair value on the S&P 500, it's probably somewhere at 2,000 or a bit below, around there, give or take 100 or 200 points. So the lows from the March 23rd were around 21.74, I think. So it's perfectly plausible we retest that or move lower. The timing is the challenge. Clearly, the market's held up better than one would have thought in the last couple of weeks. But then that's what bear market relief rallies do. They bully the shorts and they bully the bears. And I think clearly that's what this relief rally's been up to. So I think there's room for meaningful downside. Whether or not the market is then a buy, you have to think about how the macro has evolved as the market moves down towards those lows, how much more stimulus there is or is not, and how credit conditions evolve and financial conditions evolve. So yes, I think a retest of the lows is likely, or even a new low. So we're cautious in portfolios, and we would assess the global economic outlook at the time of that retest or the new lows to get a good sense of how one should position from there on out. But there's clearly lots to worry about at the moment, and I think there's plenty of downside risk from here.
Okay, one thing that I would also like your opinion about is the sort of quite massive underperformance of financials, and it's been so for quite a long time, I guess. So could you give us your view on the financial sector in general in the equity market? What do you expect of them?
Yeah, I mean, I think financials, the other side of this bear market, will be an interesting place to put money. So it's a sector that's underperformed for a long time, as we know. Many banks across the West have recapitalized and built capital buffers. And I think, therefore, that'll help them weather this storm better than they otherwise would have. So, you know, I also think there'll be inflation the other side of this crisis. So deflation first and then inflation, because of money printing and so on. And I think that will be good for banks. It'll help erode bad debt levels through inflation. More inflation means higher nominal credit growth, which is good for their revenue line. So I think they've recapitalized, they're in better shape coming into this crisis, and there'll be a place to be the other side of it. So I think buy banks on weakness. You know, they're a cheap sector. Look for sell-offs in markets as an opportunity to buy bank positions and start building positions in that sector.
Could you give us a few words also on the sort of significance of the mega cap tech stocks that has actually been driving a lot of the recent rally and supported the market for a long time in our view? What do you expect out of companies like Microsoft, Amazon, Apple, Google, Alphabet? I mean.
Well, clearly they've been real favorites in this crisis. I think it's quite interesting if you think about the whole value versus growth trade. Growth has been a real theme for the last 10 years. We've been big fans of it. It's done very well. Those stocks you mentioned are real beneficiaries of that. They're the big $1 trillion market cap stocks, the FANGs and so on. So growth's had a great run. But if you look at growth relative to value, you'll see that growth is really pretty stretched on a relative price chart, and we could perhaps focus on that in another video over coming weeks. And I think it's kind of interesting because if you look at the way growth behaved in the mid-1970s recession, it behaved quite similarly to how it's behaving now. It outperformed into the recession, and then it peaked relative to value in the midst of the recession, and then you had a long phase with value starting to outperform. So there's quite a lot to be said for value stocks. And it's not unusual for growth to peak in the midst of a pandemic, in the midst of a recession, in the midst of a major downturn. And I suspect that growth stocks will outperform over the 2, 5, and 10 years. And they're probably a lot of the good news is now priced in on a relative basis. And so that's kind of how we're thinking about those.
Okay. Well, that's it for me, Chris. Thank you very much for, as usual, very valuable and interesting insights. Look forward to speak to you soon again.
Thank you. Appreciate it. Thanks for your time, Stefan.
Thank you.